Welcome everyone to BDO's quarterly tax webinar. I'm Ben Tarry and I'm a director in the tax team here at BDO. I'm host for today's session. So whilst we do undertake a number of national and local webinars covering specific topical issues, today represents the first of our quarterly lunchtime webinars covering wider tax updates. It's not to say we shall cover all taxes during today's session, but rather we aim to cover some of the most topical issues arising in prior quarters or those we're finding hot on the agenda of our clients. So presenting today, Mark Ellis, who leads BDO's indirect tax team here in the Midlands, and one of BDO's custom duty directors, Juliet Wallwork. They will be focusing on forthcoming changes due to making tax digital for VAT and custom duty and international trade, respectively. They'll be followed on by one of our senior employment tax specialists, Raj Savjani, who will be providing an overview of the changes in rules relating to termination payments, which came into effect earlier this year. Please feel free to ask any questions by entering into the box on the bottom right-hand corner of your screen. We will address the questions once all the presentations are finished. Over to Mark.
Thank you very much, Ben. So the first thing we're going to talk about is making tax digital for VAT. A lot of firms have done webinars on this, and I think even Peter Jones is now on YouTube talking about it, so it must be something very special and exciting. So the law is already laid. It was laid in February 2018. Despite many calls to do so, it's not going to be put off. Maybe they'll change their mind in the next few months, but so far not. So when does it kick in? It kicks in from 1 April next year, and it will bite for VAT return forms for periods that start after 1 April next year. So if you've got a monthly VAT return that you file, your April 19 return is the one that will need to be subject to this new law. It's not just about how you file returns. A lot of people have just focused on that. It's just some software, and that's I give my figures to HMRC. It's a bit more than that. HMRC have expanded the records you need to keep and how they should be kept, as well as a requirement that they should be filed electronically, your VAT return figures with HMRC. I'm going to talk a bit over the next couple of slides about what that actually means in practice. So digital links is what they've been talking about a lot, and you hear a lot of people talking about that. Essentially what it means is no more copy and paste, which people who have VAT return spreadsheets, a lot of them do that. See quite a few people doing manual entries in spreadsheets. That's not great. So what HMRC are looking for is a digital journey, as they call it. Everything's linked all the way down, from the VAT return numbers all the way down to the prime records. So if you've got a great software package and you trust your VAT return numbers, maybe it's just some software that needs to bridge between your main accounting software package and HMRC's portal. Or maybe it's just an upgraded version of their software. For many others who do VAT return workings in a spreadsheet, though, using data that comes from one or more accounting systems, that's where it probably needs to change what they do. Now, there is a soft landing period for that. So the revenue is saying we give you an extra year to get that bit sorted, the links between your VAT return spreadsheets and your accounting systems. But nevertheless, we're saying it's something that should be thought about now, particularly if you've got a new accounting system being implemented. It would be wrong to do that without thinking about this law that's coming that it needs to comply with. So what we've tried to focus on is not just around, well, I need to get some VAT return numbers into HMRC in a different way, but actually try and think about the compliance that you've already got within your VAT return preparation process. Many people use a spreadsheet to do a VAT return that they inherited and the person before them inherited, and so on down the chain. Nobody really knows what they're doing. Everybody hopes the numbers are about right, and they do a reconciliation, But really, how good is it? How many checks could that spreadsheet be programmed to do? How much could your accounting system be programmed to do to make sure there aren't any errors? So we're trying to say probably it's a good opportunity this to focus on your VAT return compliance. That's how we've come at it. And then look at the digital links element and API software. Now, we've got a question mark about purchasing API software. The stuff that's coming out at the moment is it seems to be free, a lot of it. So some people are trying to charge quite an outrageous amount for an annual license for this software to file your VAT return numbers with HMRC, but others, and you see the trend more and more now, are announcing day by day it'll be free, which is what the revenue are actually after. If you think this is pitched at every business in the country with an £85,000 or more turnover that's VAT registered, it clearly can't cost a lot of money, because the numbers in the VAT return boxes, just because you might have several zeros more, at the end of the day, it is just a number that needs to be transmitted to HMRC. The data is quite small, so the cost of that should not be prohibitive. As we say on the bottom bullet point here, it's the digital links between VAT return spreadsheets and accounting systems, or even between accounting systems. Some people have got more than one. And if you've got a multi-site business with different business sites on different systems, that's when it gets a little bit more complex and needs some thought. So just to finish up and say how we have been helping our clients. One has been helping them assess what they need to do to get ready, but also more around the VAT return preparation process itself. So sitting with you and using it as an opportunity to go through that preparation process and see if it can be made slicker, take less time, have more controls built into it. That'd be great. It takes less time and you've got more certainty around the numbers. And that helps you if and when HMRC choose to do a VAT inspection, which apparently in the future will all be done electronically from some super centre sat in a city rather than by a visit. So we are helping people do that, or also helping people who are doing it themselves by reviewing what they are preparing before they go live with it. And our last bullet point here for me to finish on, it's probably not one of these things to leave until the last minute. If we've got some time now, the next couple of returns, if you're on quarterly returns, to almost have a twin track process and say, well, let's see what we've designed, see if it works, but carry on doing what we were doing anyway. We don't have to get to comply with the law right now, but let's give it a go for a couple of quarters. So that's what we are recommending to businesses, rather than just put it off until next year.
Thanks, Mark. That was very interesting. And on to Juliet.
Hi, everybody. I'm going to talk about the dreaded B word in my slot now. So I'm going to be talking about Brexit. I'm not necessarily going to touch on the proposed solutions, either the Chequers plan or the Super Canada FDA. What I'm going to talk about is steps that companies should be taking now in preparation for whatever Brexit outcome we have, because I think there are steps that companies can be taking. But to kick us off, just to run through the timeframes where we are to date, the key thing to note is the October 2018 negotiations deadline. This was the deadline that was in place when we initially started on the Brexit journey. It is indeed next Wednesday when there is a EU Council meeting to supposedly sign off on the agreed withdrawal agreement. The key issue in relation to this is, of course, the Northern Ireland border, and as of yet there is no signs, although the press does say we're 85% there, of Northern Ireland issue being decided. So what we are probably going to see is that October deadline moving back to November, December, and possibly even the latest thinking is there will be an emergency backstop in January to determine what the withdrawal agreement will look like. In addition to these timeframes, there are some other events which are taking place which will impact UK traders. The key one being that in February of next year, the electronic system which has been in place for about 30 years, by which importers and exporters file their declarations with HMRC, known as CHIEF, is being replaced by a system called CDS. Many of you will have heard the concerns that there are about delays in port happening post-Brexit. In fact, I was reading an article this morning about the M26 being prepared to be a lorry park and steps being taken to do this. This introduction of new software is not going to help. The words HMRC software updates and software implementation in the same sentence is never a good thing. So there is a real concern out there that initially, post-Brexit, we will see supply chain disruption. So what are government and HMRC, regardless, like I say, of the type of agreement we get, what are their key considerations? What are they aiming for? Well, as you know, maintaining the current frictionless movement of goods. This is a big wish list from the UK government. However, they are realistic and they understand that they have to prepare for all eventualities. Over the summer, you may well have seen a number of information papers that the government has been putting out covering all areas and all aspects of life post-Brexit, advising companies and trade what to do under a hard Brexit scenario. What the government and HMRC have said that any future solution, any future agreement, any future trading framework will rely on, wherever possible, technological facilitations and solutions. So this is important for businesses going forward, because if HMRC is implementing this, it means that businesses will have to do that as well. So what business areas do we think are going to be impacted post-Brexit? And as I said, this is regardless of whether we get a hard Brexit, regardless of whether we get a soft Brexit, regardless of what we got, we think these areas are going to be impacted, and companies need to start looking at this now. So to start off with, it's going to be knowledge. At the moment, there are 70,000 companies in the UK that import and export. Post-Brexit, when movements between the UK and the EU become imports and exports, that number is going to double. There's going to be 70,000 companies which will be required to deal with customs duties, will be required to deal with the administrative processes and the knowledge to comply with those. So there's going to be a piece around, does your company, if you're affected, understand customs and understand import VAT? In order to manage that knowledge, there's going to have to be the necessary data. Many of those new 70,000 companies won't know what a commodity code is. They won't know the formalities they have to go through to clear their goods through ports at either UK or in the EU. They won't be aware of the necessary contractual terms that they have in place, because at the moment, Incoterms that you may have in place with your EU suppliers or contractors are largely of little consequence, but post-Brexit they will become very, very important. And so companies need to understand what their contractual arrangements are with their suppliers and their customers. As I mentioned before, lead times, there is the expectation that at least initially there will be delays at port. So companies with just-in-time supply chains or perishable goods need to really think about what they can do to minimise the risk of disruption to their supply chain. Linked in with the knowledge aspect is going to be the new reporting requirements. Linked into the lead time is going to be supply chain costs. We hear talk about tariffs, but even if we have a free trade agreement, tariffs aren't necessarily in play. The real cost is going to be increased freight forwarder costs. So companies need to think now about the number of consignments they're moving between the UK and the EU and what that cost could be if they are now having to pay freight forwarders to manage the admin requirements. And finally, the system. Systems will need to be changed to capture all this data, to capture all this new information, to capture any changes that HMRC introduce in order to deal with Brexit. So my final slide is to reiterate, what should companies be doing now? Well, look at your shipping terms with your EU suppliers and customers. What are your Incoterms? To give you an example, if you are supplying to a customer in Germany on a DDP term, Post-Brexit, that means that you could be liable for any export declaration and process leaving the UK, any import declaration and process into Germany, and any additional freight forwarder costs that are incurred. So look at your terms now and see if commercially you can amend those to be more beneficial for your company. Think about applying for Authorised Economic Operator, AEO. This is a big buzzword at the moment. There are a lot of companies doing and going for this. The reason why they're going for this is companies with this accreditation will get their goods fast-tracked through the ports. And for companies with just-in-time supply chains or concerns about time in their supply chain, this is going to be critical from a business risk perspective. Look at your current supply chains. Where are your risks and where are your opportunities? Under a worst-case scenario, do you need to introduce things like customs warehousing to negate double taxation? Look at your systems and your resources. Are they going to be fit for purpose? Have you got resources with sufficient knowledge? Can your systems record the data you're going to need to? Things like commodity codes. As I mentioned there in relation to supply chains, think about duty relief. If we do have a scenario where tariffs are in place between the UK and the EU, these are going to be critical for a cost perspective. And then finally, review the economic origin of your goods. If we go down a free trade agreement route, there's going to be a lot of focus on where goods originate. This is going to become key as well. This is going to encompass other elements of here because you're going to have your history of your goods held in your systems. That's going to be data you're going to need to develop and look at. So as you can see, there's a number of steps that companies can be taking now to prepare for Brexit, regardless of what agreement we ultimately get between the EU and the UK.
Thank you, Juliet. That's really interesting to hear, and it will be fascinating to see what happens over the next few weeks and few months. And on to Raj, just to give us an update on the recent changes in termination payments.
Thanks, Ben. Today I'll be covering the tax changes to payments in lieu of notice, or PILONS, that took effect from April 2018. In summary, the changes mean that in situations where an employee is not serving their notice, their overall termination package is likely to be more costly for the employer than it would have been in the past. Firstly, I'd like to briefly cover the position prior to April of this year. Prior to April, the tax treatment was dependent on the employee's contractual position. This ranged from a PILON that was fully subject to tax and NI, because it was in the employee's contract, to a damages payment which would have generally benefited from the £30,000 tax exemption and the global NI exemption. HMRC felt the position was unsatisfactory and generally to their disadvantage, and hence the changes were introduced in April. The post-April legislation defines a key new concept called Post-Employment Notice Pay, or PENP. PENP is effectively a PILON determined in accordance with a formula prescribed in the legislation and will be fully taxable and subject to NI, regardless of the contractual position of the employee. The idea of PENP is to assess the pay an employee would have earned had they worked their notice in full and subject this to tax and NI. The first step is to establish basic pay, BP in the formula you can see on the slide. There are some adjustments as detailed on the slide that need to be made to an employee's actual pay to get to this. The next step is to quantify the pay the employee would have received in any unworked period of notice, i.e. BP multiplied by D in the formula. And then finally, you deduct any amounts already taxed as part of the termination, for example, a payment for a restrictive covenant, and this is to avoid any double taxation. The other new definition in the legislation is Relevant Termination Award, or RTA. You'll see from the examples that we'll come on to that the legislation essentially recharacterizes some or all of the RTA as a taxable notice amount. RTA includes all payments made on termination, such as compensatory payments, but excludes amounts already subject to tax for the same reason as above, and also excludes redundancy, both statutory and enhanced. Redundancy is excluded so as to protect its tax and NI-free status. So now we have two new concepts defined, PENP and RTA. The next step is to determine how much of the RTA that would have been tax and NI-free under the old rules is attributable to the period of notice not served and is therefore taxable and NI-able. There are two scenarios that can arise. Either the PENP is greater than the RTA or the RTA exceeds PENP. So taking the first scenario, here the whole RTA is recharacterised and subject to tax. If conversely the PENP is less than the RTA, then the whole amount of the PENP is taxable, with the residual RTA then being free of tax, insofar as the 30k tax exemption has not been exhausted. The next two slides provide some simple examples of how these principles apply in practice. In the first example, the employee has 3 months' notice in their contract, but due to it being a redundancy situation, the employer and employee have agreed that no notice will actually be served or worked. So under the pre-April 2018 rules, there would have been some monetary recognition of this notice not served, and the tax treatment would have then varied from case to case. Under the new rules, the contractual notice provisions aren't relevant anymore. Instead, we need to calculate the PENP and RTA and then compare their values. So in this example, the employer has agreed a compensatory payment of £20,000, which includes £7,000 redundancy. So you'll see from the slide, the PENP is actually greater than the RTA in this example, and therefore the entire compensatory award, less the redundancy payment, is subject to tax and NI, and the redundancy payment itself continues to benefit from the tax exemption. In the example on the next slide, the employee agrees to leave under settlement agreement after serving 1 month of their 3-month notice period. So in this example, the parties agree an overall compensatory payment of £25,000. Here the PENP is 10k, which is actually less than the RTA of £25,000. Therefore, rather than the £25,000 being free of tax and NI, as would have been the case before April 18, it's now broken down into a taxable and NI-able payment of £10,000 and a tax and NI-free payment of £15,000. So in summary, the PILON changes make the contractual notice position redundant. Having a contract that is silent with regard to PILON no longer has any tax advantage. Additionally, terminations are now more costly as a result of these PILON changes and will become even more costly from April 19, with a capping of the global NI exemption at £30,000 for employers to match the tax exemption. The only advantage of these changes is that the new rules are now contained in statute, giving you more certainty over the tax treatment of notice pay. So thanks for listening, and if you have any questions, please type them into the box in that corner.
Yeah, thanks. And I think anyone that has dealt with the new post-employment notice period rules will realise that even without going into some of the complexities that we come across around international aspects, you find it somewhat amusing that these changes were driven by the Office of Tax Simplification, and actually they are still pretty confusing. So we do have a couple of questions, and I will just read those out now that the group have sent in.
We've got one around private medical insurance, is that right?
Yeah, a couple just, sorry, just trying to click on so I can actually see the full questions. Just 1 second.
It wouldn't be a webinar without a technical difficulty. So I think one of them there is around, I've got one here around further explanation of expansion of records for MTD for VAT. So one of the key things is around box 6, which is the sales figure that goes on VAT returns. A lot of businesses don't really pay much attention to what is in that at the moment. And going forward, you need to have an analysis each quarter of exactly what is in box 6. What are your standard rated sales? What are your zero rated and reduced rated sales? What are VAT exempt? And what are outside the scope of VAT? And a lot of people miss out the outside the scope of VAT one. So that would be supplies that are made that would be subject to VAT if they were made in the UK, but they are made in another country. So that's one expansion. There's another one that's pretty easy to deal with, which is making sure your records contain your name, address and VAT number. If you've got a VAT return spreadsheet, it's just making sure it's actually there contained in that spreadsheet. So that's what I alluded to with extra record keeping. There's another point around making sure that you show how much VAT is recoverable on your purchases. So for a partly exempt business, that's been quite tricky. Can they actually code in how much VAT they recover on each invoice? Do they need to code in for each invoice net VAT gross? And some of those areas are bits where we're either helping clients to comply or asking HMRC if it's possible for the client to be allowed to not comply with that aspect alone of the new law. So that's what some of the extra record keeping requirements are. But those are the kind of things we pick up when we do the workshop.
We do have a question for Raj as well. So I think when calculating T of the PENP calculation, is there any discount provided for private medical insurance?
Yeah, thanks, Ben. So the T in the PENP formula is to, you subtract T, which is amounts that have already been subjected to tax, such as restrictive covenant payments or bonuses. So if you as an employer are meeting the cost of private medical insurance, now typically you as an employer will meet that directly with a provider, so it will be a non-cash benefit. So it wouldn't be deducted as, it wouldn't be included in T in the PENP formula, but you would tax it up until the date of cessation on the employee's P11D, and then if you're going to provide private medical insurance after the employee left, then there's a particular mechanism that you use to tax that. It's not a P11D, but you do still subject it to tax.
I don't know what to call it then.
Yep. And thank you. I think we do have one other further question for Juliet as well. Just in terms of, I think it's quite a direct question actually, in terms of what are your predictions for BREXIT actually, and customs duty, where we're going to end up?
I expect that we will end up with something less than the Chequers plan. I expect that we will end up with an arrangement. It may not necessarily be called this, but will be along the lines of a free trade agreement akin to what we have with the EU has with various countries at the moment. I think for some goods, providing they meet the economic origin criteria, the goods will move tariff-free, but I think it is highly likely that there will be new administrative requirements and border controls introduced.
I've had, another question come in as well for Juliet. With regard to Brexit, are the potential border clearance disruptions likely to impact goods received from China?
Yes, they are, because it will be one system covering all imports. So there won't be a system for imports in inverted commas from the EU, and imports from the rest of the world. It will all be one system, so it's likely if you have a delay in any part of that, it's going to have a knock-on effect on other areas.
That's a direct question for both of our indirect specialists in terms of, are you organising a workshop on the VAT changes, given that there's so much happening within the world of indirect tax?
Yeah, I think it's one of these things we tend to do on a client-by-client basis, because every client's got their own specific issues, either on cross-border movements when it comes to Brexit and for making tax digital for VAT, their own peculiarities of their business and how they pull their VAT returns together. Some people it's pretty straightforward, they know the answers, and others they need a more bespoke chat on the phone, or it's a situation where we meet with them and go through it.
Yeah. And in terms of the last question, would it be possible to receive a copy of the slides? Absolutely. So, yes, we will be following up and with a recording of the webinar as well following this session. So I think that brings us to a conclusion. Thank you, Mark, Juliet and Raj, for today's presentations. Trust everyone on the phone found them really insightful. And just following on from today's session, just like to hear your feedback. We'll be issuing a feedback request immediately after the call. Really keen to receive your input on future sessions in terms of the content. Would really like to invite you to suggest topics and what's really hot on your agenda at the moment. Just one final note from me. We will be holding our post-budget webinar on the 30th of October, and details will be sent to you all soon regarding that. And that's it from us. And thank you very much for dialing in today.